Every trader wants consistency, that sweet spot between catching trends early and avoiding fakeouts, but most only use one indicator at a time, missing the real edge that comes when you combine strength with direction. Today, we're diving into RSI and ADX, two powerhouse indicators that, when used together, can help day traders lock in high-probability setups and avoid costly mistakes. By the end of this video, you'll know exactly how to use them in harmony to build more confidence and precision in your trades. Let's start with RSI, the Relative Strength Index. RSI is a momentum oscillator. It measures how fast and strong price moves. It moves between 0 and 100, with key zones at 30 and 70. When RSI drops below 30, the market is considered oversold, meaning selling pressure might be overextended. When RSI rises above 70, it's overbought. Buyers may have pushed too far, but here's the biggest mistake traders make. RSI isn't just a buy low, sell high signal. It's a context tool. It tells you who's in control and when momentum is shifting. For example, if RSI stays above 50 during a pullback, it often means buyers are still dominant. If it can't rise above 50, sellers may be controlling the trend. In short, RSI helps you read strength and weakness inside price, not just extremes. Now let's talk about ADX, the Average Directional Index. ADX doesn't tell you which direction price is moving, it tells you how strong the trend is. It also moves from 0 to 100. Below 20, SOX weak trend or consolidation. Between 25 and 40, SOBR's healthy tradable trend. Above 40, BOBR's strong momentum. Often trending markets. And here's where it gets powerful. ADX often includes two lines, PUSDI and DI. PUSDI shows bullish movement. DI shows bearish movement. When PUSDI crosses above DI, buyers take control. When DI crosses above PUSDI, sellers dominate. So ADX doesn't predict price, it confirms trend strength. That's critical information when combining it with RSI. Here's the real edge. When you combine RSI and ADX, you can identify both momentum shifts and trend strength confirmation. Here's the logic. RSI tells you when momentum is reaching a turning point. ADX tells you if that turn has the strength to continue. Let's break down the synergy with two setups. You're watching a strong uptrend. ADX is above 25, confirming that the trend has power. Now RSI pulls back from overbought, maybe from 70 down to 50, while price dips slightly. This isn't a reason to panic, it's your re-entry zone. You want RSI to bounce back above 50, showing renewed momentum, while ADX remains strong. That's your confirmation to enter long, in sync with the dominant trend. It's the perfect way to avoid entering too early or fading a strong market. Let's flip it. Suppose RSI keeps hitting overbought, but ADX starts falling below 20. That means the market's trend is losing strength, even if price still climbs. This divergence, strong RSI readings with weakening ADX, often warns of a potential reversal or range-bound market ahead. Traders who notice this can take profits early or avoid entering new trades into a fading trend. Here's how you can properly use RSI and ADX together every trading day. 1. Identify market condition. Use ADX first. If ADX is below 20, market is choppy. Look for range trades, not trends. If ADX is above 25, focus on trend setups. 2. Check momentum with RSI. During uptrends, wait for RSI to pull back to 40-50, then bounce. During downtrends, wait for RSI to retrace to 50-60, then reject. 3. Confirm direction with DI lines. Ensure plus DI. DI for long trades, or DI plus DI for shorts. 4. Entry trigger. Enter only when RSI aligns with ADX trend strength and the DI lines confirm direction. 5. Exit plan. If ADX drops sharply below 20, or RSI diverges against your trade, it's time to secure profits or tighten stops. This approach eliminates emotional guessing and anchors decisions on quantified strength and momentum. Many traders misuse RSI and ADX by treating them as standalone indicators or fixed signal generators. They'll buy just because RSI hits 30, or short because ADX spikes above 40. That's not precision, that's gambling. The key is context. RSI without trend strength is noise. ADX without momentum direction is blind, but together, they filter bad setups and reveal high-probability trades where both strength and direction align. Imagine the market's trending upward. ADX is at 32, solid strength. Pulse DI is clearly above DI. RSI pulls back to 45, then bounces to 60. That's a trend continuation setup. You enter long as RSI turns up, ADX stays strong, and price breaks recent highs. Your stop loss sits under the last swing low, and you ride the move while ADX confirms strength. You're trading with the flow, not fighting it. That's how pros use RSI and ADX, not to predict, but to confirm. RSI and ADX work not just because of math, but because they track human behavior. RSI measures emotional extremes, fear and greed in price momentum. ADX measures commitment, how strongly traders follow through on those emotions. When both align, it means the masses and the momentum are moving in the same direction. That's when probability is on your side. Trading isn't about predicting, it's about stacking odds. RSI and ADX, when used together, help you see the pulse of the market, both its heartbeat and its strength. So the next time you load your charts, don't just look for entries, look for alignment, momentum and trend walking in the same direction. That's how day traders turn confusion into confidence, and confidence into consistent profitability. Master the rhythm of RSI and ADX, and let the market reveal its strength to you. Would you like me to create a visual storyboard or thumbnail concept for this script? Like what scenes to show with each section for a YouTube video? And Palmer Sanna, Daim Dates Dan in Prompt